JC, Joel, Dennis, and Brianna, how you doing?
I'm doing well, guys. How are you?
We're doing good. We're doing good. We're just taking a look at the S&Ps here. Had a quick dip yesterday, and if you blinked, the decline was over. I guess that just kind of just feeds the momentum of the buy the dippers.
Yeah, I mean, I'm someone who I like to put things in context, and when you look at the last few days, and everyone tries to come up with a reason why the market's down 100 points or whatever it is. I mean, for the most part, you guys know. I mean, it's just really noise. I think the big thing to really take out of not just the last couple of days, but over the last weeks, is that we've really gone nowhere. I mean, think about this. We've been down in the S&P 500 4 out of the last 6 days, and we've been down 8 out of the last 11, yet we're still 1% from the all-time highs. So, I mean, what does that tell you?
Ain't going down.
I mean, it can do anything, obviously, but the market's digesting the recent gains through time rather than correcting through a downside correction through price. That's how I see it. And I think that of the two ways to digest gains, the sideways consolidation is healthier than a downside correction, right? That's how I look at it anyway.
Hey, JC, I want to ask you about the TLT here. And you made a good call when that was topping out. And now you got an interesting pattern here. You pull back. You got a little bit of relief rally here. But now it looks like you're taking out the support now. I mean, this thing just paused and now another leg down here, perhaps to the 120 level. Give us your take on TLT, and that is the iShares 20-year plus Treasury bond ETF.
Yep. It was great. We saw a lot of things were telling us. I mean, I've been the biggest bond bull forever throughout all of last year, coming into this year too. But we saw a lot of divergences in terms of momentum, in terms of Treasury bonds, plus all of the rate-sensitive sectors like REITs and utilities. Really starting to kind of give us the same signals. Those are two sectors that I had liked for so long because rates were falling, so everything was suggesting kind of, back off, not to mention TLT hit our targets, so, forget everything else. That was probably the most important thing. And then since then, it's just been a tough trade, so we haven't been in it. We've stayed completely away from it. I just think there's easier places to be. I still think that, gun to my head, do we go higher or lower in TLTs? We probably go lower. Am I short? No. It's just a tough trade. I think there's better places to be. But yeah, to your point, we're probably heading lower, probably, maybe down to the low 120s, sure.
JC, let's talk about something that I know you're a fan of, and it's failed breakdowns. And we saw one yesterday. You tweeted it out on Alibaba, BABA. We also saw GoPro, similarly, failed breakdown there just from the day before. Just talk briefly about failed breakdowns here and what you think about Alibaba and GoPro now that both of these appear to maybe have had one just in the last day or two.
Yeah, you nailed it. I when I saw that I saw that yesterday developing. I mean, I had to get all over it. We're in the Baba. For me, it doesn't really take much when I see a failed breakdown like that. Most importantly, because it creates a risk-reward scenario that is very much skewed in favor of the bulls, right? Because think about the psychology behind this. You have that key support from October. We rallied and it came back down, and we broke that on Tuesday, right, on a gap lower.
Yeah.
So anybody who had stops below the October lows, those stops get hit. So they're no longer long Alibaba. Then you have the short sellers that are saying, uh-oh, this thing's breaking down. Now it's time to short Alibaba. And then what happens? The following day, the market rips, and now we're back above those October lows. So psychologically speaking, think about it. Anybody who was long Alibaba that got stopped out is no longer in the trade. They have to buy it back. All of the shorts that initiated positions on the breakdown, the only way to unwind that trade, because they're wrong now, is to buy it back. So now you have the natural buyers that are already there. Now you have the original longs that got stopped that have to buy back. Then you have the shorts that have to unwind it. Now you got the momentum guys that see this, that jump on board like us, for example. Here we are talking about it, which creates more shorts to have to cover. By the way, the short interest has been increasing dramatically the entire way down. The short interest is as high as it's ever been in BABA. Granted, the stock's been trading for 6 months, but the highest short interest nonetheless. So you want to talk about a catalyst to take this higher. I think that's it. So from a risk-reward standpoint, it's very simple. You're only long above the October lows. Below the October lows, all bets are off. So from a risk-reward standpoint, it's very much skewed in favor of the bulls. I think we go up to the to the high 90s. I think we fill that gap from late January, January 29th, right? So the lows from the 28th, which is right around $98. That's what I would be covering.
Hey, quick update here. Kroger, big beat out of Kroger, 104 versus 90 cents. Raising guidance, fiscal year 380 to 390, 372 estimate. Let's give a hand for Garrett Cook on that one that was looking for the big beat on that. You got to pop up in the pre-market trading. Let's see how high we got. 72 even, right on the kisser. That coincides with that low that the high you had at 72.11. So didn't mean to interrupt you, JC. Just wanted to see if you shopped at Kroger. They probably don't have Krogers in New York, do they?
I don't think I've ever seen a Kroger in my entire life. I'm not even kidding. I grew up in Miami. I live in New York City. We don't have those things. Are they in the Midwest?
Yeah, Midwest, big Midwest.
Yeah, they're all over the place around Detroit here. You know what I don't like about the Kroger is, though, to get the sales, you got to have the Kroger card. And I never used to have a Kroger card, so they don't give you the sales. So then you basically have to sign up in order to get the sales. I find that annoying. They'll say, oh, the price is this, but you get it, and it's more when you go to the checkout, unless you have the Kroger card. So that's what I always say.
Dennis, do you ever pay full price for anything?
Oh, I like everything on sale. I'm a trader, man. You don't want to pay full price.
Hey, JC, I want to ask you here about Apple. And, wow, look at this consolidation here. 4 days of tight ranges here. I guess the right way to think about it would be, hey, you found support here, 128. Look at this. You've had, I think, 4 lows in a row between 128.09 and 128.32. 4 in a row. Closed near there. I mean, is this just a low-risk buy here, or do you think that's going to finally cave at 128 level and give a little bit back, give some people a chance to get in cheaper?
Right. Well, I want to look at this 2 ways. If you guys remember a month ago, when Apple was about to break out, excuse me, above the highs from November, when we broke out, I said the target was 129. And you guys asked me, why is that the target? I explained there's multiple Fibonacci extensions. And then you asked me, do you just take profits or do you raise stops? And I said, no, that's the target. You get out. Well, these Fibonacci extensions, guys, they work. We hit 129 and we've gone nowhere ever since. So we've been at this 129 level for 2 weeks. So these levels work for whatever the reason, whether Leonardo Fibonacci 1,000 years ago is still dead on or there's enough people watching these levels. It doesn't matter what the reason is. These targets are hit, and then the market just stops, and we've gone nowhere since then. So I like to be patient when these levels are hit. But, yeah, now we can reevaluate, right? Now we hit the target, we get out, we back off from a less biased perspective because we don't have any skin in the game. And now to your point, yeah, this is a healthy consolidation. Getting back to what we were talking about in S&Ps. There's 2 ways to digest gains: sideways consolidation or a downside correction. The sideways consolidation is obviously the healthier of the 2. That's what I think we have here. And yeah, I think we could be getting ready for the next leg higher. I wouldn't be surprised at all. I would continue to stress that there's no reason to rush it. Be patient. I would like to start to see, it's kind of turning into kind of a little bit of a rounding little bottom over the last, week and a half or so. So I would like to do anything pre-market. It gets us up a little bit pre-market. I would like to start to see, maybe 130 start taken out, something like that. And then, you could buy it across that, with the next target up above 140, about 144.5, the next target.
Okay. Do you have a target on the downside that would you look to re-enter?
If we break down out of this consolidation, I just wouldn't want to be in it. Like, I wouldn't want to be a dip buyer in this. I guess if I had to buy dips, I'd probably be buying it under 120, from the highs from last November where we originally broke out from. But, we want to see strength out of this, right? We don't want to see weakness and get back to that breakout level. We want to see this consolidation, this high and tight pennant or flag, whatever you want to call it, kind of stay up here. That would be the healthier way to do it. And I would rather buy the breakout out of that as opposed to buying the weakness, personally. I think if it breaks down out of this, I wouldn't touch it at all.
JC, I got a general question for you. So, as a technical trader, we know you're big on the technicals. When you have an event like Apple, the Monday event there, or if let's say even you had an earnings event coming up on a stock, will you not trade that stock ahead of that earnings? Because we know the technicals, if a stock comes out and they just massively miss or something, the technicals kind of are meaningless at that point in time. Do you try to avoid like big fundamental events being a technical trader?
Yeah, I avoid event risk constantly. I don't like to be in that at all. Yeah, earnings, if there's earnings, in all likelihood, I'll be out. Or I'll have a very, very small position. Or I'll manage risk through the options market. But to be in the common, going into a coin flip, I mean, that's just not
Right.
for me. I see people getting, getting dragged out in body bags, trying to play earnings. That's not for me. If you want to start flipping coins, just go to the casino. The market's not a casino. We're here to manage risk. And when you're going into an event where you're flipping a coin, it's very difficult to manage risk. So if I'm going to be in it, I'll either be really, really tiny or I'll be in the options market. But more often than not, I just try to avoid it at all costs.
JC, are you following Ambarella Inc. at all? And the reason I'm bringing it up, they had some great earnings yesterday, and boy, they supply components to GoPro. If you were long a stock like this, if you could do you have charts in front of you just to take a look at it? How do you
You guys know me by now, asking me if I have charts in front of me. Who do you guys think you're talking to?
Sorry about
What's
that.
the ticker? What's the ticker? What's the ticker?
AMB. You'd pull it up on your phone if you didn't have it, right? AMBA, Ambarella Inc. Yeah, they AMBA.
Oh yeah. Oh, yeah.
How do you? I mean, obviously, I know you would say you wouldn't be shorting this thing, but how would you play it if you were trying to protect profits?
Let's see. It's 68 and change. This is just a very clean uptrend. I mean, I'm just taking a look at it just real quick right off the bat. I mean, I haven't looked at this chart at all, but I mean, we're essentially in a long-term uptrend channel going back to 2012. So what I would do personally if I were in this, I'd be selling at the upper end of the range. You have parallel trend lines going back a few years, and when we get to the upper end of the range, I would be taking profits. Right now that's sitting somewhere around 85 or something like that.
Whoa.
To the downside, how would I manage risk on this? Let's say I was just in right now and I'd be buying this breakout. I would only want to be in above 63, which are the former highs. We break below that, all bets are off. If I really want to be tight with this.
Okay.
It's a little too short term for my taste. I probably wouldn't be buying that breakout. But I mean, if I were in this right now, I would only want to be in it above the former highs, which are the January highs around 63 and change. That's how I would be it. Below that, things would get a little messy.
Okay.
Personally.
All right, Kroger just blasted above 74 here. Holy.
Yeah.
74.32 backed off here. That obliterates the former all-time high at 73.60. So once again, good call there on from Garrett. Let's just take a look at a couple other momentum stocks here. Google is really caught a bit as of late, and over the Barron's over the weekend. I'm not sure if you read that or not. They gave it a little bit of boost, and what a nice move. Is this thing finally, waking up here? People are, finding some value in it. Look at this. 1, 2, 3, 4, 5, 6, 7 up days in a row. Could you give us your take on Google?
Yeah, well, I mean, I would argue that it's not that people are finally starting to see the value. I mean, we're talking about, one of the biggest companies in American history sitting at all-time highs. So I think, for the most part, people have noticed that this thing is pretty valuable. I've liked the internet stocks, guys. You know this. I've liked the internet stocks for over a month. I love them all. Google's obviously a big component of that. Remember, guys, we discussed the Dow Jones Internet Index. There's an ETF for that, FDN, Frank David Nancy, and Google's a heavy component of that. The FDN is at all-time highs. It includes some of the other names. More recently, I like the social media names, but still within that large space. But yeah, I like Google, and getting back to how markets can digest gains. Think about from the highs a year ago in Google. I mean, we literally have, and don't just look at a daily time frame on this. Look at a weekly time frame in Google, and we essentially have a falling trend channel, defined by parallel trend lines going back to last year. You can call. I mean, it looks like a bull flag to me. I think we break out of this and we're off to the races, and we see all-time highs very soon. I think your confirmation in terms of a breakout above the upper end, I mean, you're probably looking at around 580. I don't know, 583, 584, and we're off to the races. But, yeah, I think it happens soon. I think the sector looks great. I think Google's one of them. I like the whole space. I mean, what's there not to like? They're the leaders.
Okay, let me
throw them in there with healthcare.
Let me throw in a few other tickers. Just a real quick technical look at them. Morgan Stanley. We don't talk about that on the show much here. Moving up, consolidation here. Potential breakout on this one, huh? Any thoughts on Morgan Stanley?
It's an underperformer, terrible sector. Financials have just not been a place that you want to be, for the most part. When you talk about, leadership, financials are just not part of that conversation. I mean, this is one of the worst sectors in one of the strongest markets we've ever seen. So is this really where you want to be? Morgan Stanley, it doesn't do anything for me. You guys have brought up such great names like Baba with a great risk reward, and, some of the leaders like Google and Apple, and then you look at a Morgan Stanley. I mean, there's just, why bother?
Yeah.
Okay. Could it go higher? Maybe. Could it go lower? Probably. Could it continue to do nothing? Most likely. That's how I look at it. It's just dead money. And opportunity cost is a risk that not a lot of, from what my experience, not a lot of people include in their, in their risk metrics. But opportunity cost is risk nonetheless.
One final question for you from Rodhood out of the chat. Does JC believe in the buy and hold concept, or is that a dinosaur in today's world?
Mutual funds have spent a lot of money brainwashing people that buying and hold is a strategy. That's obviously not a strategy. If you're buying and holding, what's your time horizon? Where, what are risk management wise? How are you going to manage risk? We get 2008 and your portfolio's cut in half. Like, is that cool with you? Like, is that the risk that you're willing to accept? I don't believe that's a strategy. I don't care how much money mutual fund companies have spent brainwashing people. It's not a strategy.
Okay. All right. Great comment on that. JC Parets, founder of Eagle Bay Capital, joins us every Thursday here on Benzinga's Pre-Market Prep, giving us his fundamental and technical outlook on the market. Thank you, JC. We'll talk to you again next week.
Yeah, thanks for having me. I'll talk to you soon.
Okay.
Thanks, JC.